It's been wild this weekend. The crash was pretty impressive when you see those cascading liquidations. A lot of us were on a call while it was happening live, and you're starting to see the weakness hit the market and Bitcoin draw down, and it doesn't really hit you as any big deal because that happens a lot in Bitcoin, right? We've seen lots of these liquidation events, but then all of a sudden you start to see the book get really thin. And all of a sudden Bitcoin's jumping around by the thousands of dollars within seconds. And it was pretty clear that something along the chain had broke. And almost always when you see this type of price action, it means the leverage is getting hit. There's a reason why most people should never touch leverage when they're trading cryptocurrencies. And this is the reason. It's because you've got these automated liquidation engines that are driving all of these trades. And as soon as one cascades into the other, you start this chain of events. And what was really interesting with that post that came out, and it was by a guy named Elon Trades, was it showed effectively the trail of what happened and how all of this was effectively triggered by a coin called USDE with 60 to 90 million dollars being dumped on Binance and causing the initial liquidation on Binance. But what people were really focusing on was the tie to the larger macro event, which was the tariff announcement from Trump. And it just was when you see things that seem too orchestrated, there's the old saying, somebody always knows something. What a way to mask this type of an exploit. And it was interesting because Binance had already identified this exploit and they had communicated that there was a patch on the way for it. And so there was only an 8-day window where this all would have been possible. And they managed to do that Friday afternoon, right after the markets had closed. You immediately get the news of the tariffs hitting. You start getting initial weakness in the market. You start this liquidation cascade. Everyone ties it to the news out of the White House, even though that would have been surprising, right? Because this is not our first tariff rodeo. I actually think one of our very first episodes, we were talking about tariffs then, and the markets were getting hit by the tariffs at that time and then bouncing back and recovering much like we saw today. But it was one of these perfectly timed executions to exploit the collateral engine on Binance using that USDE token and causing the forced liquidations, which ultimately I believe amounted to over $19 billion, which is larger than the FTX collapse. It was larger than anything that happened with COVID. It was the largest drawdown or liquidation that you saw within the crypto complex. So it was a really major event. And I think what was ultimately interesting was when you watched it play out, maybe we've just been around this too long, but it didn't really feel like that much. You watched it, it didn't pull Bitcoin under 100, although on some exchanges where it got really thin, I did see that there were some trades that were some orders that were filling right around 100. So it drew it pretty low. But Bitcoin overall, people stepped in on the bid. There were buyers on Bitcoin. And you didn't see that with all the other tokens. A lot of the other altcoins that were out there drew down 70, 90%. You saw some really major wipeouts happen in that side of the house. Bitcoin overall showed pretty good resiliency, bouncing back from that very quickly. It did not hold down there very long before it had recovered back to the 112, 113 range, ultimately getting above 115 here. And it was a good battle test, I will say, for Bitcoin. It shows when everything really starts falling apart around the crypto industry. I think what you saw over the weekend was where that capital rotates to. There's a fleet of safety within that overall industry, and Bitcoin is the most established and the most liquid of all the digital assets that are out there. And when panic and chaos hits and all these other ones, I think what you saw was that capital goes to where it believes it to be safe, which is in Bitcoin. So I thought that was actually a really good highlight for how Bitcoin can withstand what most others cannot.
Yeah, Bitcoin dominance had a huge green candle. All of this happened in 10 minutes. We were all on the phone watching it together. And I think it dropped down to 100 for just a split second and then went right back up. And we were all trying to put buy orders in personally on trying to buy the dip. And then all of a sudden it was back above 110. And this happened in 10 minutes. We were all on the phone. It was just a wild experience to watch it all happen in real time on the phone with people.
Yeah, what was to me the most wild thing was someone on the call got an order filled under 105, And the price that I was watching, I was looking at the Bitstamp price, and it was above 110. And so this kind of got into the where it became clear that this was a leverage flush more than just a broader market sell-off at the time. We weren't watching all the altcoins at the time. We were just watching Bitcoin. Was the breakdown of price between the different exchanges, which really only happens in very large liquidity-driven leverage flushes. Typically, you'll see very orderly, at least nowadays. In the early days of Bitcoin and crypto, you would see in 2017, as an example, big differences in the price of Bitcoin across different exchanges or altcoins across different exchanges in different countries. And there was a massive business if you could actually arb those price differences, and they would last for a long time. We don't see that in the price of Bitcoin or even most other altcoins even today. And you saw that breakdown even with Bitcoin was pretty surprising to me. So that was indicative of something that was much larger. And I think there's several reasons why you could say the altcoins did substantially worse, the flight to safety. But I think another thing that's really interesting there, and I think this will have longer term negative repercussions for altcoins, is that a lot of the market making for altcoins are done by retail traders on decentralized exchanges. And these people they've worked up to have 10 million, 50 million, $100 million of capital, and they're market making, they're doing farming or whatever they're doing on various different decentralized exchanges. And most of those accounts blew up. And I think that with that, the market making function for a lot of altcoins, I think, are severely to permanently damaged, actually. And I think that's going to have a lot of medium to long-term negative repercussions for the liquidity of those different coins. But it also starts to get into why I said last night I'm the most bullish I felt in a couple of years. And that was not a tweet to say, or an X post, I should say. Tweet is out these days, but an X post to say that Bitcoin is going to rip this week, although it might, or next month. But this was a massive leverage flush. And you think about oftentimes when you have a bull market or the beginnings of a bull market that I think we've seen in Bitcoin, obviously equity markets, gold up, that a massive leverage flush where the price of the underlying asset isn't even down 10%, puts a massive bullish tailwinds for the price to go up higher without leverage actually getting out of control, because the leverage was just completely wiped out. And so it doesn't matter if the next move up happens this week, next month, December. This is a long-term leverage flushing event because of the magnitude of it. And I think it clears the ways for substantially higher prices for Bitcoin, where if you would have asked me, do I think that Bitcoin hits 200K in 2025 a week ago, I would have said very unlikely. And at this point, I would say it's more likely than I would have said a week ago because of the clearing of the overhang to move higher in prices that I think will be fairly long lasting. And I guess the last point here is obviously I feel bad for people that got wiped out, for people that take too much risk, put too much leverage on. But I think a big part of this show and this message that we've continually hammered is obviously the zoom out mentality. And then obviously also with regards to how you think about leverage, why there's so much, I would say, underappreciated value in Bitcoin treasury companies that are able to actually put on leverage in a perpetual manner. Because you could take literally Bitcoin to 1 penny, which I wrote a post on as well. And I said, I didn't dunk on altcoins for losing 60% of their value, because I don't think that proves that they have no value. It's many other reasons that they don't have value. It's not the fact that it flushed. Just how if Bitcoin flushed to a penny, I would be on the hurdle rate next week saying buy the dip, as long as the fundamentals hadn't changed, and they probably wouldn't have changed. It would not change my thesis. And so downward pricing, if fundamentals don't change, whether it's Bitcoin or an equity, should not change your view of the asset. It's actually the fundamental side of the equation. And I think obviously with regards to Bitcoin, the fundamentals remain strong. And if you have your leverage in a perpetual manner, you can ride out any downturn as long as the time is not a 6, 8, 10-year time frame. Like you've actually zoomed out the time frame, which no other leverage allows you to do.
Yeah, the one piece that I think is important for people to understand is that this was actually driven by a stable coin. And so there's been a lot of discussion about stablecoins, and people go out to these exchanges to try to apply leverage to their trades. And a lot of times they'll use stablecoins as the collateral. And what happened in this instance was there was a weakness where Binance was using their own spot market in order to value the collateral. And so when you have a stable coin that's supposed to be pegged at $1, but then you have this coordinated dumping of that stable coin in the market, it drew down the value of that stable coin temporarily in that spot market to 65 cents, which for anybody that had margin, it compressed your margin requirements. So it put you into these margin calls and it started auto liquidating your positions. So while everyone felt like they were in a safe position because they were holding a coin that was supposed to be stable, because of that exploit, what most other exchanges would do is they're using this kind of group consensus. They call them oracles, where you're out there and you're actually taking pricing from several different spot markets and then you're aggregating it and you're creating this smooth pricing so that volatility on any one exchange isn't going to cause this problem to yours. But in this instance, Binance was just using their own spot market in order to value this collateral. So it shows you that even when you think you're doing the right thing out there and using stable coins as the basis for the way that you're going to apply leverage, it's not necessarily the case. There's so much happening behind the scenes. These exchanges are incredibly complex. This is emerging technology, and it's being built very quickly and deployed very quickly. And that can often mean that exploits can be missed, right? Vulnerabilities can be out there. And because these are exchanges where people can make money by finding and exploiting those vulnerabilities, they're going to continue to try. So you just have to know what you're in for if you're willing to go this far out the risk curve. And this is far out on the risk curve, right? This was when you saw a lot of the historic blowups in Bitcoin, a lot of what drove that price action as well was these offshore exchanges that were giving people 50x leverage or 100x leverage, which meant price didn't have to move very much before you'd be in a scenario where you could get liquidated. And if enough people put on really high leverage, all you have to do is weaken it slightly and they just start cascading into each other. So you got to be careful out there. Obviously, if you're buying Bitcoin, the safest thing to do is just buy the asset. Don't use any leverage. Don't apply that type of risk to your own portfolio. And there's a lesson in there, as Matt said, for any of the treasury companies as well, which is the type of leverage you have matters a lot. And a lot of us saw that pretty clearly when Strategy had the secure loan. And at that point in time, all you would see on Twitter in particular was people trying to calculate their liquidation point, and they were just waiting for the time when the markets would try to flush out MSTR's position and liquidate them. That was the conversation that was happening. So luckily, we've been able to learn from that. Even Strategy learned from that. I think there's no scenario where they're taking that same type of a secured loan again, but the type of leverage you select to apply on your balance sheet matters a lot.
Yeah, I think that it's super important when people are thinking about leveraging their own personal Bitcoin stack if they're looking to take a loan out on it. There are terms on I think a majority of those that have liquidation terms. So if the price of Bitcoin goes down to a certain threshold, your Bitcoin gets sold and it's gone and the loan is closed. And that protects the lender. And so that type of leverage that you take on is incredibly important and it shines a light on the opportunity here. Like corporations can take more efficient leverage than a person can just going to take out a loan on their individual Bitcoin. But one thing that I pulled up here, this is the CoinGlass liquidation leverage chart. And I look at this just from time to time because I think it's interesting to watch because you can see how the market makers move with leverage. So this is looking at Binance leverage over the last 6 months. And you could see this big wick down over here on the right-hand side. This is the event that happened on Friday where it came and hunted out all of this leverage down to the bottom, basically down to where there was no leverage in the market on the Binance exchange anymore, and then started to work its way back up. So it's fascinating. And you could see the different colors here is the different size of the leverage. There's at 106,923, there was $571 million of leverage just at that one individual spot. So it's just a fascinating piece to watch, and you see how the market moves relative to leverage at different time horizons. You can come up here and change the different place. But the other thing that, Matt, I think you hit on, which is really interesting, is this concept of liquidity too. And I've been thinking about liquidity just a lot and liquidity risk and how this plays into just global macro markets and how it's evolving and changing. And the unique thing here is you think about like a publicly traded equity, it's mark to market every day, every trading day, like during the day. It's all what you could go see what it's worth every day. And whereas you look at more opaque markets, like private equity might actually be significantly more volatile than public equity markets because they're just not mark to market every day. You just don't know, you don't see what the value of those specific things are every day. And there are situations where valuation of the fundamentals of the company or the commodity may be just going up and to the right, but you've got the value that's bouncing up and down and around because it is mark to market 24/7. And with equities, they're mark to market all day during trading days, 5 days a week. It's interesting to think about that construct moving forward. Like liquidity risk and liquidity really matters. And you think about a more dynamic digital world, like everything is getting more and more liquid, and that this is the way the world's economy is going. Yeah, it was a fascinating event to be a part of, and it's exciting to have that now behind us. And we're still at 115K, right? Like leverage has been wiped clean. As you say, the altcoin markets are they're different now. Like we're at a new point in time, all that leverage being removed from all these other altcoins. There's a different amount of focus on Bitcoin and Bitcoin moving forward. So exciting time.
Yeah, it is exciting times and definitely not boring times. And I guess the last thing just from conversations that I don't think we've hit on yet was we've heard some comments about market makers still making pretty wide markets across in Bitcoin and in other obviously altcoins. And so that kind of leans itself to that this is still working itself through a little bit, even though a lot of the leverage has been flushed, that we're not seeing the type of markets that we've normally seen, which means there's a higher potential for volatility in both directions. And that's not to say that we make new lows or anything like that, just to say that things might be a little bit more volatile before it clears up as market makers kind of lick some of the wounds that they got over the last few days.
What is interesting is that the altcoin markets are largely recovering, which I find fascinating with the speed because Bitcoin dominance is basically exactly where it was before the event again. So it had that immediate spike while everything was going on, but since that time, it's reset. But to your point, Matt, these events tend to have market makers very spooked, and they're going to be very hesitant to come in and narrow those spreads on these assets and make those markets in a tight manner. So we'll see how long that takes to shake out. There might be more volatility on the way. We'll just have to see.
Yeah, I think it would be pretty clear for the market as a whole that the Max Payne trade would be straight up from here. Not to say that happens, but imagine you were a crypto native person your whole life. An exploit of Binance wipes several of these large accounts up and then you just rip up. That would be obviously very painful for them, but that's often the way that things go. So we shall see.